Hey there, it's Mike Langford. Welcome to the Augmented Advisor podcast brought to you by Blue Leaf. This week on the show, John Prendergast and I are joined by Jamie Wise, founder of Buzz Holdings, for what promises to be an episode that will change the way you think about the chatter on the internet forever. I know, right? That's a bold claim, but trust me, if you've never done a deep dive on sentiment analysis and considered what might be possible if you applied some high-powered AI and machine learning to make sense of the millions of tweets and posts flying around in the ether, oh yeah, you're gonna want to buckle up for this one because we're gonna get nerdy with it. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, YouTube, or wherever you like to get your podcast jam on. And if you have a question or suggestion for a guest or a topic for the show, please feel free to reach out by shooting us an email at podcast@blueleaf.com or swing by the website or hit us up on the socials. Blue Leaf, John, myself, we're all active on LinkedIn, Twitter, and super easy to find. Okay, let's get to our conversation with Jamie Wise. Jamie Wise from Buzz Holdings. So wonderful to have you on the Augmented Advisor podcast. Welcome to the show, buddy.
Hey, it's great to be here. Thanks for having me. Looking forward to it.
I've been looking forward to this for a while.
Very exciting show today.
It's going to be, actually. So for those of you who are listening and or watching the show, be prepared to buckle up because we're going to get a nerd on when it comes to this show, because there's so much really interesting things here. And even if you're not somebody who's really technical and understands how technology works, and we're going to be talking about artificial intelligence and machine learning a little bit here today, trust me, you're going to really look at the internet a little bit differently and think about how it affects investments a little bit differently after today's conversation.
But I encourage everybody to get their nerd on. I mean, look at me. I came dressed for this, right? For those of you who can't see, I'm in a plain black t-shirt, the uniform of technology. So I came ready to rock it, Jamie. Are you ready?
I don't have my hoodie on, but I can go grab it real quick. We all have our glasses on, so weve got part nerd at least going here. But I do have a hoodie off camera.
I should have gotten the hoodie. You're right.
That's right. Well,
guests are always wise, Mike.
That's right. The hoodie. I'm ultimate nerd. I'm standing desk with the surfboard, right? The desk that I've got underneath me today. So that kind of makes me feel extra hip and startup-y. Well, Jamie, I'm so thrilled to have you on the show. You and I have done other podcasts before and spent a lot of time together. And you know that every time you and I chat, I literally can't get enough of what you're doing at Buzz Holdings. It's just, to me, it's just the first time you described it. For those of you who can try to imagine, we're like beachside in Coronado, California, having a couple of drinks, and he describes what it is that Buzz does, and I'm like, that is awesome, right? So let's dive into what Buzz Holdings is for the listener and audience first, and then we'll get into kind of the meat of it.
Yeah, and I'm always happy to have a chat with you, Mike, because you were the first person that loved it and understood what we were doing. Because when we started this journey, and as you know, it's been a journey over 5 years ago. The index has been around 5 years ago. 7 years ago, we started the journey. We started talking to people about, why we cared about investor sentiment, why we cared about what people were saying online about stocks. And back then, people just laughed at me. I mean, people that we worked at said, why do I care about, Sally in Indiana and John in Ohio, what they think about Apple and Microsoft? And I said, you guys you don't get it. And I had to go all the way to Coronado and meet you at a friendly environment for someone to say, yes, here we are with our friends at StockTwits and Stocktoberfest. And sure, we understand sentiment and community investing. So I was amongst friends and very glad to still count you as one of those friends.
That's funny. It's so interesting. So for those of you who are listening to the audio only and can't see Jamie, it's not like he's a dude fresh out of college and he was just trying to pitch this idea to a bunch of grizzled, professional investor types who are like, yeah, kid, this isn't going to work, right? It's no, dude, you've got a wealth of experience in this industry. You're running a very successful hedge fund and you're like, we're going to turn this sentiment analysis loose on the world. Good.
Buzz was my first side hustle, right? Even before I knew the phrase side hustle. But sure, my whole career has been in finance. I'm an equity derivatives guy by background, so, a bit geeky and a bit skeptical in that regard. And the reason we got down this rabbit hole of sentiment was, 7 or 8 years ago when StockTwits had launched, it was gaining followers, and I was paying attention to more and more people going online talking about stocks. And I really didn't know what to do with it at the time. I didn't know fancy words like machine learning and AI and natural language processing. All I knew was there's going to be more people talking about stocks as people get more comfortable. It was the natural progression. They talk about their social lives, then they talk about experiences with products and brands and restaurants and vacations and all those things. Surely they'll be comfortable talking about stocks. Those numbers are going to increase over time. And I don't know what I'm going to do with the data, but I really want to understand what they're saying. And I want to understand which stocks they're talking about in a positive way and in a negative way, really before even thinking about an index or how we could incorporate some of those insights into our hedge fund. But thinking to myself, if we could figure out with some accuracy, what people think about individual stocks and get away from this whole, or at least prove maybe, is sentiment contrarian or is it not? Get away from polling and proxies and really use data to make decisions around sentiment. Could we find some interesting insights? And like I said, that was the beginning of the journey. And then I had to, I'm an old guy now, so I have no computer programming background, but very fortunate to be up here in Toronto, where the University of Toronto was just down the street, and their computer science division, as many people know, was led by Jeff Hinton back then, who's, sort of now known as the godfather of AI. So they have a wealth of local talent that we could tap into and collaborate and figure out what kind of people and models do we need to make sense of this data set. And that's really where it all started. And then, sort of led to the index, which we put out there back in December of 2015.
And so for those who are very new to Buzz Holdings, the index, and now there's an ETF available as well. What is it? Like you just described the sentiment and what drew you to this and so forth, the sentiment analysis. What is the Buzz Index?
So, perfect question to start. The Buzz Index, in our mind, is a fairly simple aggregate view of broad investor sentiment across large cap US equities, right? So it was developed as a way of demonstrating, proving that either sentiment had predictive value and stocks that exhibited high amounts of positive sentiment would do better than broad benchmark, call it the S&P, or this thing sentiment is contrarian. And the only way we're going to know that is to create the index, put some thought around its construction. We can talk about how it's created and rebalanced every month, and then see how the thing performs. And then more importantly, look under the hood at the types of stocks that are driving performance. And so the way we first thought about the index is we wanted to make it relatable and investable. And that's why we focused on large cap US equities, right? There's lots of conversation on, thinly traded small cap stocks and things like that people have never heard of. We wanted to look at stocks that had market caps of 5 billion or higher so that people could look at the underlying holdings of the index. They could see these stocks, they know them, they're not new to them. And then we needed a tool to be able to measure aggregate sentiment. I'm sure we'll spend a lot of time talking about that today. But for now, let's just say we have a tool that can score all these millions and millions of posts, people talking about these large cap US equities. And it's a two-step process. The first is we create an eligible universe out of the 5 billion market cap stocks and higher. So not every stock is eligible. It has to be a stock that's talked about in a broad and diverse manner across online platforms. So not just a few people talking about it or a sudden spike in conversation because of a corporate action and then no one talks about it ever again. There are stocks that are being discussed across Twitter, across StockTwits, wherever people are talking about stocks in a meaningful way. And that takes the universe from, call it 1,300 or so stocks that have market caps 5 billion or higher and breaks it down to 300 or 400 stocks. We look at that every single quarter and we determine which stocks are eligible to be included in the index. And once we get that list of 300 or 400, we're not measuring sentiment yet. We're just looking for breadth and volume of conversation. Then we measure the sentiment of those stocks on a monthly basis. And the top 75 most positively discussed stocks are featured in the index, weighted based on their sentiment strength. So the more positive the aggregate sentiment around the stock, the higher the weight it is in the index. And we cap the weight at 3%. right? So we don't want to have one stock, disproportionately large within the index. What the index is trying to deliver is this sentiment factor, this thing that's been around, in our opinion, forever, but we can now observe and measure, and rebalance it monthly, because we think of sentiment in that time period, right? We're not trying to capture very short-term moves. It's not a high-frequency strategy. We want these stocks to be seasoned, talked about stocks. We'll talk about that a little bit later, I think, with some of the meme stocks. We can get into that when they come in the index, when they're not eligible to be in the index. But once they're in, they have to have that kind of sentiment momentum to them, and then it gets rebalanced. So it's a very dynamic index. It has no constraints around sector exposures or things of that nature. Just most talked about 5 billion market cap and higher stocks rebalanced monthly.
And Jamie, something you said there is pretty important, I think, for our listeners to remember. Sentiment's been around for a long time, right?
Oh, absolutely. And that's why I've always been interested in it, right? Because I'm here in financial markets, and it's pretty clear to all of us in markets that sentiment has an impact on price discovery. Like, we know that intuitively, right? The problem is in the financial world, we've often been told or trained to think of sentiment as something that's contrarian. And there's never been a good way to measure sentiment, right? So we either had to rely on proxy measures like put call volumes or retail investment flows, things of that nature, or polls, or we have to turn on our TVs and see some expert, so-called expert, sitting there being interviewed and saying things like, XYZ stock, it's time to fade, this sentiment is too high. And of course, how does that expert know that? I don't know. Is he or she looking at a stock chart? Maybe they're having a dinner conversation with colleagues, but there's no sort of data behind all that. And that's what always frustrated me, is that since the first day a stock traded on the exchange, in the floors, in the pits 200 years ago, we know that the emotions of those traders, the sentiments of those traders drove asset prices, drove security selection. How do we measure it? And what the big change really was the emergence of these online platforms, right? Now you have forums like StockTwits where millions of people can gather and talk about stocks individually. So it's not a macro view of equities or a macro view of bonds or something like that. It's, I like Disney versus Microsoft versus ExxonMobil versus GameStop versus pick a name, right? And now you have millions of data points that are stock specific. And with data, we can actually say that, aggregate sentiment on Disney is different than Microsoft in this way. And it's been changing and trending over time in this manner because we've been watching it for so long.
So, you said something there that I think is important, right? And I want to dig in a little bit on the digitization of sentiment. Because as soon as there was the internet, essentially, there was online sentiment, right? And we've had things like Yahoo message boards and AOL and the Motley Fool and now StockTwits and some more modern platforms. So, that's the last 20 years. So what's really changed that's made this a viable strategy to automate and turn into an index now?
So this is where the modeling comes in, right? And the advances in this field of natural language processing, right? In the early days of natural language processing, a simple way of thinking about it was just dictionary translation, right? There would be dictionaries of words that would be associated, these are positive words, these are negative words, and then a computer could look at a whole bunch of posts and try and find those words and then label them as positive or negative. That is very tricky when it comes to stocks, right? People use very different language when it comes to stocks. Different words can mean different things. You could even have a stock-specific language, but of course our language changes over time. Meme stocks wasn't even a word 2 years ago. That's true. And now it's a very big word, right? Same goes, for the use of emojis within text and conversations around stocks, right? When we started building our models, very few people used emojis, right? The early adopters were text-driven speakers online. Now, just like everything else in our lives, emojis are a big part of, the online posting environment. And as individuals and people who are in markets, you can read a post and exactly, or with a high degree of confidence if the individual that made that post is talking about that stock in a positive or negative way. So how do you get a computer to do that? Well, that's machine learning and natural language processing. And all that means is instead of using a dictionary-based approach to identify positive and negative words. You're using examples, right? So it's the same way that you and I have learned, by example. And you need a very large data set of examples to train those models, right? And we have that now because of, well, really places like StockTwits, right? Where millions of posts are self-labeled by users. So you can train computers using recent data, the way people talk about stocks today, to understand the nuance of that conversation and understand which types of, and there's lots of different models you can employ, which word groupings, letter groupings, sentence groupings, but the way people talk about stocks, that is reflected in a positive way and in a negative way, so that when the model sees a new post, it has a much higher degree of probability of accurately labeling that post or scoring that post as being positive or negative. And it's important too that, you know, the data set that you train the models on is domain specific, right? So people talk about, you know, vacations and Amazon reviews very differently than stocks. So where this branch of natural language processing started, which was in consumer products, really, you know, companies like, I don't know, Apple wanted to know what people were saying about their brands. You couldn't just take that model and say, okay, now go point it at StockTwits and tell me which stocks are being positively talked about, because the language is so different. So we had to spend a lot of time, and we wanted to do this in-house, and we, you know, build all our own tools so we understand how they're trained, how they work, is building those models and training them specifically on the language of the day that people are talking about with respect to stocks, so that we have comfort that the output of those models is accurate. And once we have that accurately labeled data set, it's just about aggregating that data, right? It's not asking, you know, the machine to give us some magical insight from that, right? Where this is a different, you know, there's a lot of AI-based investing that people talk about today where, you know, machines are giving stock recommendations, right? What we do at Buzz isn't that. We're not asking a machine to give us a magic stock recommendation. We're just asking the machine to accurately label all the posts for us, because there's so many millions of them that, you know, we couldn't do it manually. But once we have confidence in the labeling process, we just aggregate that information, and then we can reflect it back to the community as the Buzz Index.
That's fascinating to me, and I always feel like I want to like translate this a little bit for some of the listeners who might be going, okay, all right, sounds super nerdy and interesting. Like, why is this important, right? You know, historically, a lot of the indexes that one would benchmark their performance of the portfolios of their clients against or invest in because they're buying index funds, most of those are kind of backward looking in their construction, right? The S&P 500 is the 500 biggest, best companies in the U.S. market, stock markets, but it's backward looking. We look at, okay, who were the best 500, and if one starts to suck in the next couple of quarters, we take it out and replace it with the one that performed better over that time period, right? What Buzz is doing with sentiment is looking at all of the discussions and the intent to buy or the intent to sell that is happening on the internet in places like StockTwits and Twitter and so forth, taking that information as an indicator. Hey, listen, these are the stocks that people are interested in and acting upon. These are the ones that should be in the indexes. So it's not backward looking; it's actually forward looking. You're seeing intent, right?
It's so dynamic, right? And I couldn't tell you that I expected it to be as dynamic as it is when I launched it 5 years ago or 6 years ago now. It's all about the names under the hood. And you're right, it's unconstrained in how it finds those names. So when you're talking about the S&P 500, simple market cap screen. When you're talking about momentum indices, right? Simple historical look back on price momentum, right? And, whatever formula you want to use to define price momentum, but it's backward looking. Even names like ARK, for example, which might be viewed as forward-looking because they're thematic in their forward-looking views, are very constrained in the box that they can live in, right? But Buzz doesn't have to be. So what you see in Buzz with sentiment, why are people talking positively about a stock, right? It's pretty basic. There's two reasons. One, it's going up and they think it's going higher. They like the story, it's growth, or it's value. Right? It's fallen too far. It's unloved. It's got a good dividend yield, a solid balance sheet. There's a million value reasons, right? And so what you get in the index, and you see it in the contributors to the returns every year, like year in, year out, it's not just momentum stocks. It's not just thematic stocks. It's a blend of all of them. And they each have their time to shine. And the index is dynamic enough that it can, hopefully pick up on the shifting, attitudes of investors and keep up and outperform, right? And we've lived through that in the last year, right? We had this huge rotation out of growth into value that, it wasn't forever, but there were value names in the Buzz Index that really helped keep its performance, outperforming, frankly, in those changing market environments where if you're a price momentum index or if you're constrained in a thematic idea, you can't travel outside that box. You don't have that same flexibility. To me, that's the most important takeaway from the Buzz Index is that you do get this blend of stocks and, the Buzz, and it works, right? So for the last 5 calendar years, Buzz has beaten the S&P 500, right? It's beaten it by a couple of percentage points or it's beaten it by 40 percentage points, but it's beaten it year in, year out. And when you look at even this year, I look at the top contributors and I look at the top 2 are Moderna and Novavax, right? So pharmaceutical companies, okay, I get why those are performing well. But then I also look down the list, I see NVIDIA and Twitter, tech companies, then Plug Power, thematic play, meme play, American Airlines, Ford Motor Company, right? They're the next 2, and then GameStop. Okay, so find me a active portfolio manager or an index that can deliver such uniqueness in the top 10 contributors to return across, quote, sector, right? Some of those names are contrarian plays, right? They're not contrarian to us because all of these stocks exhibit the same thing, which is positive sentiment. But in many people's eyes, a Ford or an American Airlines would be viewed as a contrarian play where you've got, maybe price momentum names continuing with NVIDIA in the same top 10, right? So you get this blend of styles, blend of value growth, blend of all these things. But the thing that they all share in common is that they have positive aggregate investor sentiment, and we can measure it.
So in some sense, if I'm an advisor constructing a portfolio and I'm worried about style drift, I really have to think about this as its own new style.
Yeah, well, it's not new in the sense that sentiment's always been around, but it doesn't have a style, right? Its style is sentiment, right? I think sentiment is as much a factor as, size and profitability and growth and all the factors that we're used to. It's just now that we can measure it, we can put it alongside it, and it's not correlated to any of those things. It is its own factor, right? So as an advisor, and I know there's lots of advisors out there, and I talk to some of them that are really thoughtful around this idea, right? That they've got, this core allocation to equities, and then at the margins, they think about their factor tilts. Sentiment's a factor that you need to pay attention to. It was hard to get people to listen to that story, I think, for a few years. And then in January, the story got hijacked a little bit because of GameStop and the whole, that whole online movement. But it at least awakened people to the idea that, hold on a second, there really is a large community of people out there talking about the stocks. They do have impact on markets, and they are looking at things through a different lens than traditional Wall Street analysts are. And maybe it's worth paying attention to them. And what we've tried to deliver in the index is enough history now that people can take that idea seriously.
Jumping a little ahead here, we had for those who are listening and watching, we have these little show notes or kind of like the conversation starters we have, and we talk about it beforehand. But you just mentioned something that I think we need to jump on it now, because you talked about what effectively is termed the wisdom of the crowd, right? Versus, the listening to just only the professionals. The GameStop scenario that happened. And for those of you who, I can't imagine somebody's unaware of it, but if you need a reminder, right? Some folks out there on the investment boards and so forth noticed that there were some large short positions in GameStop. And these investors took it upon themselves to really put the squeeze on on the short positions and started buying like crazy and drove GameStop valuation up. And so it was one of those big news breaking events that showed there is a power in this sentiment, because it also comes with action, right?
Yeah. Now, GameStop's really interesting to unpack. From my equity derivatives, investing hat, it shows you in January that the online community is a lot smarter than people historically gave them credit for, right? That idea of a short squeeze, of identifying that opportunity, of just that independent analysis, they were right? The hedge funds were wrong. The crowd was certainly right and got it on that trade. So, that's a validating point for me that these aren't people that are just, especially in aggregate, right? This community of people is armed with more information today than ever before, right? 10 years ago, we're all looking at 15-minute delayed stock quotes and, sell-side research to try and make stock recommendations, right? And today, the internet is just full of information and everything is happening in real time and people get that. So that's interesting. Now, GameStop was not in Buzz in January, okay? So why was that, right? And now there was AMC and some of these other meme stocks that we've come to know them as meme stocks. Remember that first screen that I talked about, that it's sort of a safety net, I think, for the index, right? So we need to see stocks that exhibit a high amount of conversation and that have a $5 billion market cap and that are being talked about in a diverse way, right? So GameStop and AMC were not eligible stocks for Buzz going back in January, because, well, first, they didn't meet the $5 billion market threshold. And the second is we look at that conversation over a 1-year period. GameStop did have a lot of conversation, but it wasn't a $5 billion stock. And we only rebalanced that quarterly, that eligible universe, right? So from the period of January 1st to March 31st, GameStop just wasn't eligible for the index. And a lot changed within GameStop in those 3 months, right? It went from a short squeeze meme stock, and it might have been any 3-letter stock, right? It didn't matter. It had no fundamental merit to it. And people know it today, and you go online for a few minutes, you'll see the conversation today is around GameStop is completely different, right? It's all about fundamentals. Total wholesale change of management, activism, rejigging their business model, all these stores, from a price to sales basis, GameStop is far from the most expensive stock in the market, right? So there's a lot of debate around GameStop as a value stock and as a transitional stock, and what will the future of GameStop look like? And so GameStop became eligible for Buzz in April. And from April to today, it's, like I said, one of the top 10 contributors to performance, but it had nothing to do with the short squeeze, right? It's really a fundamentally talked about stock now. And a lot of these meme stocks are, right? So, I think that's an important distinction. And with headline news that a lot of people see today, they still think of GameStop as something that it isn't, right? They still think of the January GameStop where, we have this window into the conversation that we really see it as a different stock, right? And it belongs eligible for the Buzz Index. Whether it will always be in the Buzz Index is a different story. We don't make that decision. The community's collective sentiments will make that decision. But it's certainly been a really interesting story and stock to watch over this past year. And it's really, like I said, the story's changed, and we'll see if the company can deliver, based on what the sentiments of the community are expecting it to deliver, and if it will continue to perform. But it's an interesting one to watch.
It's interesting as I've been thinking and listening to this conversation. There's something here that's bigger than Buzz Holdings and the Buzz Index right now, and the way that you're doing things. I think it's a new dawn of rules-based investing, right? Where we have the machine learning, natural language processing, artificial intelligence, more broadly, that is able to take a set of rules that we give it and act upon it, versus us having to sit down and evaluate things, at one by one or whatever, or just having no other option other than just, kind of buying some, low cost index funds that we don't know anything about, right? Here you have a Buzz being a tool that has rules in it. As you mentioned, $5 billion market cap, right? It has to have so much, momentum of conversation happening on the internet. And so, these rules in place, and that's how something ends up in the index. And as soon as it falls out of those rules, it comes out and something else will replace it. That's kind of new for the average financial advisor to have access to that, and the average financial consumer to have access to this type of technology, even if they don't understand how it works.
It's new, and I like the rules approach to this because it helps keep discipline, right? And some of the names that we've seen over time, our partners over at Van Eck who have licensed the index, they like to describe it as collective conviction. I would say it avoids cold feet, right? So names like AMD and NVIDIA are two names that I've watched in the Buzz Index. They've been consistently in this index for 5 years. And I remember, they first came in and they were a 7th or a 10th of the value today. and watching, the financial community's reaction to the rise in those stocks. When you see a stock double and then triple, and everyone says, well, it's overshot and it's due for a pullback, and things like sentiment are too high, et cetera, et cetera. I can just point back to the index and the data and say, well, look, AMD and NVIDIA, they're in the top 20 positive conviction stocks month in, month out. What does the community understand better than the talking head on TV or the Wall Street analyst? And part of that, I could, turn around in my office back then and see, the group of programmers behind me trying to get all these graphic processing units to build computers to make sense of the data. So I understood in one sense the demand side just by turning around. But
so you're the guy
really,
that makes it so I can't get a new graphics card for my kid's gaming computer. It's all your fault.
Yeah.
It's people like you.
And then go to GameStop, right? And go try and buy one of those things. Not easy, right? I had to do the same thing for my kid and line up and put myself on a waiting list for his GPU. So you get it from that perspective. And then you also get that the community did a really good job at theme identification, right? That the world wasn't changing, that GPUs and gaming and the AI applications for these, this hardware and all of these things were not going away, and that in fact accelerating. And look at those stocks, right? And so the rules-based approach, Mike, that you were just talking about, and the discipline within that, and looking at the collective conviction allowed me every month when I saw, AMD double to say, well, the community is still so bullish on this, it's staying in the index, and it's not, me as hedge fund manager or, expert analyst Jamie Wise saying, well, it's doubled, let's take some money off the table and that's good and we'll be happy, and then watch it double from there. And so I think that's, again, part of what you can capture through the process within the Buzz Index that is much harder to capture whether you're an active, Wall Street portfolio manager, or if it's just part of a much more passive approach to investing, like the S&P 500 or some other factor that you're trying to accomplish.
Well, in this case, from a technical perspective, the rules are all based on you translating what is essentially gobs and gobs of unstructured data, making it structured, right? Through this natural language processing process, and applying AI to that to sort of extract the sentiment and the like, and then the rules get applied on top of that. So you've got this really interesting combination of technology doing the job to bubble things up, and then the rules that humans decide on making the decision, right? So it's a really fascinating approach.
Yeah, it's a blend. And the rules, if you can go on our website, investwithbuzz.com, the index guidelines right there, download it, have a look. If you really want to nerd out, you can read through every last detail. But the rules are human-based rules, and they're based on us as being investment managers and portfolio managers for so many years. What makes common sense, right? Common sense still matters, I think. And so, these ideas of a stock's conversation having to season before it becomes eligible, of, diversifying the index across 75 names and not having overweight to any one name, sort of overshadowing the sentiment story or return stream that we're trying to deliver. And then the monthly rebalance, right? This, sentiment's a lot like volatility, right? To those familiar with volatility out there. And typically the shorter the time period, the more volatile the asset class can be, right? And sentiment's no different, right? So you can see changes in sentiment intraday, daily. Are you trying to capture that? Or are you trying to do something a little different in the index, which is a little longer term view of sentiment, right? More of a fundamental aspect or approach to measuring sentiment than a technical approach where you're trying to capture the next tick in the stock. There's room in that for the market. There's technical traders and high frequency traders and all those other things. But when we're thinking about the discipline and the rules around Buzz, we wanted it to really just make sense to people, to advisors, that this isn't the meme ETF that's trying to capture, a quick burst of conversation online and rush out and, pile into a stock because it's just going to go higher. It's more thoughtful than that. It's trying to bring people exposure to this thing that we all knew existed for many years, centuries, sentiment, and make it investable and quantifiable as opposed to, by gut instinct or proxy.
And isn't that really how you keep the volatility of this in a sensible place, right? So for our listeners, I'd imagine they might be surprised to learn what this looks like on a volatility or correlation, like a beta basis.
Yes,
so can you talk a little bit about that?
For sure. And again, our partners at Van Eck do a great job at providing some of these statistics. So I encourage them, if you know, to dig into them, you can go onto their website, and there's a lot of this there. And I mentioned earlier that yes, we've outperformed the S&P, but you know, how have we outperformed the S&P? I guess is the question. Is this just a massive sort of leveraged beta play or not? And the answer, it turns out, is not, right? So when we look at our annualized return over the last 5 years, Buzz has been at 27% versus the S&P's just under 18. Okay, but how do you get there in terms of risk? Buzz is typically 5 to 6 volatility points higher than the S&P. So Buzz has done that on a 20 vol. The S&P's done that on a 15 vol. But Buzz has a higher Sharpe ratio. So risk-adjusted return, you're being compensated for that added risk that you're taking in the index. And the upside downside, I know we previewed this a little bit better. I asked our friends at Van Eck to update the statistics for me so it could be exactly accurate on our chat today. So over the last 5 years, Buzz has an upside capture of 118 and a downside of 82, right? So there's your asymmetry that you're really looking for. And it's just not correlated to things, right? Not as much as you would think. A lot of people will have that intuition. This is all momentum stocks. This isn't momentum stocks at all, right? Buzz is different than the momentum index. It performs differently than the thematic index. It's a little bit more volatile. You know, historically, you've been compensated for that risk. I've definitely noticed in up markets, Buzz for sure outperforms, you know, the downside capture of less than 1. That's a big number for us too, right? And I think what that shows is intuitively what I've seen over the years, which is it's not all technology and high-flying growth names. It's got that mix of styles. There's value names in the index, right? So when momentum and growth and technology fell out of favor for value, you know, Buzz wasn't a levered play to the downside on that, right? And that's that dynamic nature. And of course, it can change, right? And we didn't talk about, you know, how the index changed really even in the last year and a half, like coming out of COVID. You know, that was the most active rebalance we've seen. And it was so interesting because, you know, sure, names like Zoom came right into the index, but so did names like Carnival that weren't in the index that had just fallen 80%. And, you know, sort of the community in aggregate said, no, Carnival's not going out of business. And that's, you know, too far, right? And so super interesting stuff on the names and, you know, the styles, the sectors that get reflected in the index, how that changes over time. And the statistics are what they are over the last 5 years of sort of watching that play out.
That's really fascinating. You mentioned, you know, Carnival and the like. You know, a lot of things have happened that most economists didn't think was, and most of us intuitively didn't think was going to happen during COVID. You know, the greatest example is real estate prices exploding, right? You're thinking to yourself, like, nobody's going to move, nobody's going to buy houses. There's a lot of people lost their jobs or out of work or businesses went under. So there's going to be this tanking of the housing economy. It's going to be brutal. And in fact, it's been the opposite, right? Have there been things that Buzz has surfaced that the average person just, I guess Carnival is one. Any others that are like, hey, counterintuitive to a global pandemic shutting down parts of the economy?
Yeah, to me, Carnival is a great example of that. I remember a few years ago when, if you remember, Valiant, or now Bausch Health Companies, was in the news. That was also an interesting one for me. And this is one that collectively, I don't think the community got it right, but they didn't get it terribly wrong, which was impressive to me. So I remember that big run that it had, and it was never in the index, which I always thought was kind of interesting, right? Here's just a real, you know, go-go growth story, price momentum stock, and it never had high sentiment. And then I guess when it started falling from, where was it, 250, 300, it took it until it got to about $30 a share, right? Until it first debuted in the index. So like, where is that point where the community thought, you know, there's a breakup story here, there's a value story here, there's something to it. It went lower and came back, and it wasn't a meaningful contributor to returns, but it was really interesting just to see, you know, it had so much coverage on traditional media and CNBC, and yet the community either saw through it on the way up or very patiently waited for an entry point on the way down. Similar story, I guess, you know, was Carnival. And again, the collective conviction coming out of COVID, Mike, as you were talking about names like Zoom or Peloton, you know, which were never in the index before, and then all of a sudden they were in, and they stayed in for longer than you would have thought, right? Zoom was a name. How many people said that this stock was way ahead of itself, and it's either doubled or quadrupled from, those first conversations, and it's been in the index, and, not necessarily to max 3% weight. Its weight has definitely oscillated over time, but it's been there, and again, that collective conviction, I think, allowed the exposure to stay in the index for longer than most, active expert managers may have kept it in. And the index benefits from stuff like that.
It's fascinating. So, one of the things that I would encourage, so I can imagine like advisors are listening to this, right? And as a general, demographics would say, the average advisor is around 60 years old. So not all of them are going to be aggressively using social media to, talk about investments or listen what's happening in the world with investments. And some of them might not be comfortable or familiar with machine learning and that type of technology. So there might be a little bit of apprehension, like, I'm not sure this is something that I should even be thinking about. So that I would kind of encourage somebody, hey, go to Twitter or go to StockTwits, type in the stock symbol, take any stock symbol, Apple or Google or whatever it is that you're interested in, Zoom, right? And look at a couple of pages of tweets. Number one, look at the number of tweets that came up in the search results. It's going to be a lot. And then kind of read through them. Random people you don't know, like, what are they saying about it, right? And you might be pleasantly surprised. Like, you'll start to get it just doing that on your own, right?
That's the perfect promotion, I would say, is to go on to StockTwits, right? The first thing you'll notice when you're there is the amount of conversation. So you'll instantly recognize why you need a machine to read all that conversation and label it, because you can't read it all yourself, right? Especially if there's something happening that day. The conversation is happening so quickly. It's impossible. You could spend 5 minutes and see hundreds of posts, and then how do you digest all that? And what about the other hour or 8 hours of the trading day when people are talking about the stock? You have another job to do, right? You can't just spend your day reading all day. You wouldn't be able to do it. So you need a machine to make sense of the data. You'll see posts that you agree with. You'll see posts that you'll disagree with. You'll see thought-provoking posts, things that you hadn't considered when you're thinking about the stock. That's what all of this is about. And it's really about there being no one expert, right? I don't believe in it. It's so hard for any advisor, portfolio manager, asset manager, to get half their stock picks correctly, right? If you do that, you're Warren Buffett, essentially. So, your batting average is so difficult in this industry. And I think the freedom from the traditional investing lens that the broad community has, it's not just people in New York and Connecticut, who are trained a certain way to think about a stock. It's people from across the country, from Austin, from Idaho, from California, everywhere, each contributing. And the model doesn't give any extra weight, Mike, to your opinion, or John, yours, or mine, or anyone's, right? It's just an aggregate view. And certainly there are influential people on social media, but their votes don't count more than yours, right? And what's great about those influencers, quote influencers, is that they drive conversation, right? So if an influencer, you used to see this with, President Trump way back when he first started tweeting about stocks. It's not that he knew, we used to refer to this as diminishing celebrity returns, right? Diminishing returns of influence. Because the first time, an influencer or President Trump talked about some stock, whether it was Boeing or whatever he was talking about that day, it had a short-term but a noticeable impact on the stock price, right? And then over time, humans were conditioned to expecting this kind of behavior. So the reaction, it just fades. No influencer is really going to meaningfully move a stock, but it drives conversation. So if influencer X has something interesting to say and they have a big following, now you've got tens of thousands of people, chiming in. I agree. I disagree. And their opinions are just as valid. And the aggregate of those opinions is what buzz is, because that's the aggregate. That's the aggregate order book of the market, essentially, right? How many buyers and how many sellers do you have lined up, and where are there more buyers than sellers? That's we're measuring that in sentiment. So really important. Go online, check it out. You'll see the conversation. You'll understand why you need a machine to read it. And if you haven't been on, you'll probably be amazed at just how much conversation there really is out there. It's fantastic. And I can tell you from when we started, thinking about it like in monthly posts counts. When we started this back 6 years ago, let's say, it was about 2 million posts a month across all social platforms. And back then I was like, that's a lot of information, right? Today it's 7 or 8 times that.
Wow.
And in the last year and a half, it's doubled. So it's essentially doubled post-COVID and 7 or 8 times higher than when we started this journey. It's amazing to me to see how many people, have accepted this and go on. Why do we talk about stocks around a dinner table or, around the water cooler, right? Because we're looking for feedback and ideas and, what do you think of my idea? And now, well, that's what the internet is, right? It's the globe's water cooler of conversation. So it's the most perfect thing for this type of conversation. People derive value from it. And I'll say, even interestingly, as return to work is a thing and people are back to their offices, they take these sites with them on their mobile tablets. Like they've bought into the utility of, social engagement and conversation around stocks. And the message volume is not starting to wane now that we're, coming out of COVID. It's maintaining itself and still increasing. So interesting to see how, like in many things, COVID was a little bit of a push to get more people to these online platforms, but the user engagement stays really high.
You put poor John to sleep. What happened? Joking.
I can nerd out better than you, John.
I know, John.
Well, that'll remain to be seen. Listen to the episode on cryptocurrency. There's plenty of nerd to go around there.
That's right. So, John, we were talking before we clicked the record button about we should talk a little bit about like some other applications of sentiment analysis, right? Especially that's tapping into this big data sets that are happening. I mentioned millions and millions of posts. What are your thoughts on other areas you would be interested in seeing, a Buzz index like analysis? Should we go on debt? And looking at debt securities, or I don't know, is there enough chat for that? What do you think, John?
Well, Jamie probably knows this a lot better than I do, but debt's a whole different animal, and that's not as interesting, and there's not nearly as much conversation about that. But I suspect that there are other sub-factors, right? If sentiment's the main factor, I wonder if there are sub-factors that pop up in that sentiment that can tip us off to other aspects of behavior within the any given equity. Jamie, are there patterns that you're seeing starting to emerge that might be worth considering?
You can imagine we've done a lot of research internally on our own data set, right? The first thing that was of interest to us was the short side. But what you find, the short side is really difficult. And much like traditional Wall Street, the online community is generally more positive than negative, right? People are choosing stocks to buy more than they are thinking about them to short, right? So it's probably 80% of the conversation is tilted positive. So you don't have the same collective conviction, I'd say, on the shorts. But there's derivatives around sentiment that are interesting to us, right? Certain ratios, trends, just different ways other than the aggregate of sentiment, which is what Buzz is, of thinking about that, thinking about aggregating individuals. There's a big movement towards, if you think of some of the biggest hedge funds in the world, like a Millennium or a Citadel, those types of shops, they're really pods of experts, right? Are there ways of grouping individuals into pods to make super recommendations? And can you use machine learning to do that, right? You have so many users. How do you think about putting some of them together? How can a machine identify some patterns amongst the users to put them together and essentially free the human capital, which is an enormous cost for a Citadel, to identify, hire, and then what happens when that team underperforms? Firing them is difficult too, right? If you can do all that anonymously, it's could be very powerful, right? So we spend a lot of time thinking about those types of applications and are testing some of those in our hedge fund strategies today and have been for a number of years. So there's lots. There's so much, and of course you mentioned crypto, right? Buzz does not hold crypto; it's U.S. equities only. But there is an enormous amount of conversation on crypto, and unlike fixed income, where maybe people are talking about treasuries at large, let's say, or some Eurodollar contracts. They're not talking about corporate bonds, bond by bond, not in enough volume that it's relevant. But now there are many, many cryptos and versions and spin-offs of cryptos, as you know, and the amount of conversation there is very large. And we have to be very careful around that conversation, actually, because there are many crypto, quote, tickers that share the same ticker as equity tickers, right? And so our models need to know when someone's talking about a crypto, and so as opposed to the equity, so that they don't, confuse sentiment around a crypto and think that they're talking about the equity. A lot of thought's gone into that on our part as well. And again, that was something that didn't exist 5 years ago when we started building our models. And today it's very relevant because there's hundreds of crypto tickers.
I'm curious if you have put any thought into multi-factor modeling. In other words, you take your sentiment as a core factor. Have you ever thought of comparing that or combining that with, say, more fundamental factors, or sort of, creating these sort of multi-factor indexes built on that sentiment analysis, but enriched in some way?
Well, I've always thought that the advisor community does a pretty good job of that, right? I think that there's a lot of thought in the advisor community around doing that. It's sort of like a multi-strategy hedge fund versus a single strategy hedge fund. I think the sentiment factor that we can identify, score, measure, and what we've been doing in Buzz for the last 5 years is unique enough that I didn't want to, or I don't want to, pollute it with other factors in a multi-factor offering, right? Because then when we look at the return stream, we're having the question, what's driving those returns, right? Is it the sentiment? Is it something else? Is it the way you're combining it? And I think there's enough tools available to advisors to be able to do the analysis that they need to do on Buzz and see how it fits within their own portfolios and with their own factor exposures. And they can come up with something that fits their needs as opposed to me telling them what their needs should be. I've kind of always believed more in the single strategy approach in that regard. If you can have something that's unique, don't mess with that and let others combine it in a thoughtful way that fits their own client base, risk tolerances, all of the things that are important for their own practice.
It's like roll with what you're really good at and let other people do the other stuff. We're getting ready to wrap it up here because I know we're getting close to the end of our time together. But one thing I'm going to chime in on, just as kind of my little translation for some folks, because I know that when you talk to some folks, they get a little nervous about machine learning, right? It's the black box, right? It's like, oh my God, what's happening there? Like, it's going to kill my practice. I'll put my clients in this type of an investment, and it'll torch me. It's not really a black box, though, right? Machine learning isn't like just, hey, here's a machine, let it go run on its own, right? There's a lot, as you've heard over the course of this conversation, there's lots of human interaction. You look at the results, you go in, we've got to ask some better questions. Like, we don't want to pick up the cryptocurrency tickers because those don't belong in this analysis here. So there's lots of iterative stuff. And do the answers that the machine gave us, were they right? And if they weren't correct, why weren't they correct? Let's see if we can do that and ask better questions, right?
It's to me very important, right? I get I would not even be comfortable with, a machine just telling me to buy ABC stock. Like, why? Why did you make that decision, machine, right? What was important to you about that analysis? And that's not at all what Buzz is, right? Buzz uses technology as a tool to label millions of posts and then puts together the output of that model through a common sense rules framework with some safeguards around it, so that it's not this super high risk, don't invest in Buzz, the VanEck registered product that the index is licensed to, if you're expecting to, beat the S&P by threefold, right? It's not that. They're large cap US equities that are talked about a lot. What we're showing in Buzz is that you can put those large cap US equities together and organize them by sentiment and deliver something really unique. That's not, this black box risky thing. That's not what it is. It's the tool. AI, machine learning, that's a tool that enables us to have a high degree of comfort that the posts that they're talking about the stock from an investment perspective. We didn't talk about this, actually. It's important. The posts that we care about, if someone goes into the Apple store, has a great experience, goes to Disneyland, has a good or bad experience, and posts about that, that is not going to influence Buzz. We only care about when people are talking about the stock from an investment perspective, right? These are people involved in markets. There's lots of research around the influence of brand or brand perception and how that influences stock prices. That's not what we're doing here. We're really quote unquote polling or listening to people talking about stocks from an investment perspective only, using tools. Technology has great tools that enable us and allow us to accurately measure that individual's intent, whether it's positive or negative or neutral towards that stock, and then aggregate them through a rules process. So it's not the scary black box investing that a lot of AI things can be, right? We can tell you why is AMD in the index? Why is Moderna in the index? Well, our models last month processed X million posts and X 10,000s of those related to that stock. And, each one of those posts were positive or negative, and they're aggregated, and there you have it. And maybe the sentiment was, higher than a 3% implied weight, but we capped it at 3%, normally distributed down the weight through the rest of the 74 other holdings, and away we go, right? So it's very easy to understand. When you go into StockTwits, it's easy to understand, the amount of conversation that's there. It's just really giving back this idea of sentiment, or pushing back on some of the biases that people might have on sentiment. And I think we needed 5 years of index returns in a live environment, not back tested or anything like that. We had to grind through these last 5 years so that people have enough data to see it in their FactSet models and compare it to other factors and make sense of it and get comfortable with it and look through it. Look at the holdings. I always say, look at the holdings, look at what's driving returns. That's the real interesting story of this dynamic thing called buzz.
That's fantastic. Well, Jamie Wise, this is amazing. I told you guys we're going to be nerding out. This is really good. I always get smarter when I listen to talk to you guys. You're so in the depths of it. I just kind of sit back and just chill. Jamie, I suppose some folks are probably going to want to follow up with you. What's the best way for people to get in touch with you if they want to learn more about what you're doing there at Buzz Holdings and learn more about the index and by extension, the ETF?
Yeah, for sure. Go to the website, investwithbuzz.com. All the white papers and index guidelines are there. And like I said, the index licensed to VanEck over the last year. So, reach out to your friends at VanEck or head on over to their website. It's pretty easy to find, BUZZ. And lots of good content to dig into. And you can connect to me through the website if you want to follow up. As you can see, I've been talking about this for so long. There's a passion side hustle for me now.
Side hustle. I love it.
But it's great to be out here for so long and really appreciate you having me on the show today to talk a little bit about it.
Thank you.
It's been great, Jamie.
Yeah. Thank you very much, sir. Thank you very much for listening to or watching this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed the conversation as much as we did. Huge thanks to Jamie Wise from Buzz Holdings for getting nerdy with us today. Honestly, this is a topic that I never get tired of learning more about. I mean, it's just so logical, right? People are talking about investing online, and those conversations can be analyzed and acted upon. The future has arrived, as my old college accounting professor used to say. As I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform, and do us a favor. Give the Blue Leaf page a follow on LinkedIn. We share every episode of this show on LinkedIn, as well as a lot of other content, and we would love to have you be a part of our community. Okay, that's it for today. Please make sure you stay safe and be nice to each other. We'll see you next week on the Augmented Advisor podcast. See ya. Bye.